It is June the 1st. Michael Vaughn with Brian Acker. And Brian, let's get started with a review of May's performance in the U.S. and Canadian funds.
Absolutely. So in the select U.S. value 50, we're about, looks like over 7%, looks like 7.25. The benchmark is just a little over 10, so I think we were 4 percentage points behind. I think maybe 6 weeks ago, 7 weeks ago. So we're gaining on it. And in Canada, we're about flat for Canada, and the looks like the benchmark, our S&P TSX 60, is just a little over 3.6%. So again, we were 4 percentage points there, and we're gaining on it there. So hopefully by year end, we're at least close to our benchmarks.
I was at a financial conference, and all they talked about was, the crash. I mean, it's so much gloom out there. And they go, oh, that's reduce risk, reduce risk. Do you buy it?
Well, again, as everyone knows, we have our model price work. We have our own work here that we look at. And look, the internet is filled with stories of doom and gloom. But we have to separate here is we're investing investors' capital, and we want to find areas where there is value, and there's lots of areas with value. So especially in the U.S., it continues to lead the way in terms of value. Yes, we're up a long way from the bottom of March 9th. But there's still value in certainly the large, let's say the top 100 companies of the S&P 500. So if we had a correction, let's say a 10% correction that we haven't had in over 920 days, by the way, a long while, but again, just those stocks would get cheaper. And then what would happen, maybe, these stocks would rally, but the overvalued, the areas where most of the money has gone into over the last, say, 5-6 years, maybe it's the yield-sensitive stocks.
Yes, now you're getting onto something.
Maybe it's the REITs. Maybe it's the energy companies. More of the commodity companies that pay a yield. Maybe they correct more, or maybe they go down initially, like the market. The stocks that have value come back up, but those other sectors continue to deteriorate. So it would seem to me where you're most vulnerable for correction are those areas of the market that money has been attracted to over the last 5 or 6 years, that their fundamentals are deteriorating substantially. We see this literally every day. We don't have any money there, obviously, but also too, that area could be vulnerable to a situation that you...
Well, you see, I buy that story. I think a correction is possible, but I think it is in those sectors. People say value investing's over. I don't think it is, but I do think that where people have chased yield, focusing on yield rather than valuation, I can see that sector being in trouble.
Right, and we just don't know how it's going to manifest itself. And at the end, is it just a valuation correction? So, and again, we went through a financial crisis in 2008. Though, that type of crisis or correction rarely ever happen. And it happens because of the financial system. The financial system, for what you think of it, is well capitalized now.
Yeah.
It's not going to come from there. Will there be a macro event that actually scares people, just in terms of stocks? Well, okay, if it's a macro event, we know the central banks on the other side willing to push and pull levers actually to help out. So I'm not saying it isn't going to happen. It's just that if a correction does happen, all stocks might go down, but all the stocks are not the same. And so what will happen is, and what we've seen many times in my career, is the good stuff comes back very, very quickly. The overvalued, the bad stuff continue to go down. So I think there is a possibility of that happening, but again, we haven't had a correction now for, again, over 900 days. So what's to stop the saying it's over 1,000 or over 1,200? So again, it's very hard, if not impossible, to time this thing.
Well, the other thing the bears say is that the stocks, good stocks, are too expensive. If you look at your top holdings on the S&P, do you think they are maxed out?
No, and you know, I say this on BNN all the time. Look at Apple, the number one the number one weight in the S&P 500. We have a market value or a model price of $162.
Mm-hmm.
Currently is trading at 130. Could it correct? Yes, it could correct, but it would open up more value between what we calculate in terms of our model price, 162, and let's say if the stock went from 130 down to 120. That could be one that obviously comes back quicker than what people think. So yeah.
The strong companies have never been stronger if you look at their balance sheets.
Absolutely, yeah, they're fortresses.
Yeah.
They're accumulating cash literally every day, and really the outlook is quite uncertain. So where the CEO is going to spend it, and what you're seeing is more M&A activity and more buybacks.
Buybacks. Well, that's it. You know, I was looking at some numbers in the Financial Times. In 2014, there were $550 billion worth of buybacks in the S&P, and only $85 billion of new money went in.
And there you see. I mean, again, equities are getting scarcer by the day, just in terms of the amount of money that's being returned to shareholders, but more money is not coming in. So if you look at the number of companies on the S&P back in the late 90s versus today, it's almost half the amount of equities. You're not seeing as much IPO activity, certainly in the last 10 or 15 years. So again, yes, there is a scarcity, I think. There is value. If there is a correction, so be it. But I think it will be short-lived with the stocks that we have in our portfolio. So.
It's always a great discussion with you, Brian. Thanks for your time. I will see you in July.
Michael, always a pleasure.